today. I'm going to be sharing, like Suzanne said, some of the findings from my recent research report into carbon capture facilities in Canada, with a focus on the Pathways project, but also other projects in the province and across the world in general. Uh, Next slide, please. So essentially, the focus of this research, I was concerned with the financial feasibility of CCS projects in general. Specifically, I wanted to know, does the cost to capture, transport, and sequester 1 ton of CO2 exceed the revenue that can be expected to be generated from that process realistically and on average. In order to determine that, we had to also determine or outline what are the revenue sources for CCS facilities. What are the costs that are typically incurred by these CCS facilities and these CCS projects, the construction costs as well as the cost to operate these facilities on a day-to-day basis. And should project proponents, sponsors, as well as stakeholders, investors in the communities expect these to have excess cash flows over the life of operation or not? And as well, what are the financial risks that are involved and are likely to be encountered by stakeholders who are involved in these projects? So I'm going to share some findings with you on that digging that we did, the research, and I'll start with a background on the Pathways project. I'll go into some methodology and how we designed the research, and after sharing the findings, some conclusions, and then, like Suzanne said, we'll open it up for Q&A. So it's just some background on the Pathways CCS project. Next slide, please. I'm sure a lot of you may be aware already. The Pathways Carbon Capture and Storage Network is an ambitious plan by the Pathways Alliance, which is made up of the largest oil sand producers in Canada, to capture CO2 from 13 or more oil sand facilities and transport this CO2 via a 400-kilometer pipeline to a central storage location somewhere in the Cold Lake region of Alberta. The projected stated capacity for this project is about 10 to 12 million tons of CO2 per annum. And Pathways Alliance has provided a general estimate of cost of about $16.5 billion. We don't have a breakdown as to what elements make up that $16.5 billion. We just have a ballpark figure that has been released to the public. Next slide, please. So delving further into CCS models, what are the expected project revenues for CCS projects in Alberta and in other jurisdictions? We found out that primarily carbon credits are expected to be the main source of revenue for these projects. A viable CCS project would aim to capture enough CO2, which would then generate enough carbon credits that could be monetized to cover construction costs as well as ongoing day-to-day operational costs. Another source of revenue for these projects could be transport tariffs. This is especially relevant in Alberta, where the government is promoting the hub model, whereby different emitters that are geographically located in a similar and close proximity would share central infrastructure and central storage sites. So the developer of the carbon capture network would be able to charge each of those emitters a tariff for transporting their CO2 from the capture site to the location where this should be eventually sequestered or stored underground. So that is a secondary source of revenue for certain projects that have the hub model incorporated into their business plans. Another source of revenue is enhanced oil recovery. This is essentially delivering captured CO2 to oil and gas producers. The captured CO2 is used to stimulate oil production for wells that may be old and depleted. In exchange for delivering that CO2 that has been captured, the oil producers typically would provide payment to the CCS project proponent, and that could also be a source of revenue. For the pathways for what we have received, what's been released in the public domain, this particular project does not appear to have plans to engage in enhanced oil recovery operations, but that could change, or maybe that hasn't been released. There's not been a lot of transparency as to what the plans are going forward, but that is a potential revenue source for CCS projects across the globe. Next slide, please. When we look at costs that are involved with CCS projects, they're typically grouped into three general categories. We have capital costs, operating costs, as well as non-operating costs. Capital costs refer to cost of construction in general, or that could also be capture equipment, purchasing of capture equipment, pipelines, construction and infrastructure, land acquisition or land preparation, as well as work on the storage subsurface reservoirs where the CO2 is eventually sequestered and stored. Operating costs refer to day-to-day maintenance, equipment repair, labor, energy costs, which is a huge chunk of cost that these facilities incur, as well as ongoing monitoring and verification of CO2. And non-operating costs refer to insurance costs for facilities, as well as financing costs, interest, and depreciation and taxes. So a crucial metric for our research was the levelized cost of CCS. This is essentially just the average cost of capturing, transporting, and storing 1 metric ton of CO2 over the lifespan of a project. The levelized cost would typically combine all the categories of costs and give you one metric. And it's very useful for comparison of projects, across different jurisdictions, or even in the same jurisdiction, comparing efficiency of projects within the industry, and can also be helpful when comparing to expected revenue in order to form an opinion as to the viability of these projects. Next slide, please. One thing that we noted with the CCS projects is there appears to be a high variability of levelized costs for CCS projects amongst different industries and different applications. So if you want to analyze carbon capture costs, there isn't one range of costs that you could just pick. There's a lot of variability, and key factors that affect the cost of running these plants is the pressure of the CO2. The lower CO2 concentration in the flue gas tends to require higher energy and leads to higher costs. The scale of the project, what sort of technology is deployed, and the layout, the design and the layout of the facility also has a factor. Some CCS projects have their sequestration location located in close proximity to where the source of CO2 is captured. And some, as in the case of the Pathways proposed project, you have a central storage location that is 400 kilometers or so away from the capture sites, where you have to build a long, a lengthening pipeline. And if you see that sort of project, you would expect to have higher transport costs as opposed to relatively to another sort of project that has the sequestration site close by. So there's a lot of variability from project to project. Next slide, please. So what we did was reach out to Pathways to try to get what their average cost estimates are for each ton of CO2 stored for the project that's being proposed. We were unable to get any material feedback from Pathways Alliance. We believe that they should have this information because a lot of work has been done into the design and internal estimates exist, but for whatever reason, we were unable to get that information. However, luckily for us, large-scale CCS plants in Alberta, there are currently two, which is the Alberta Carbon Trunk Line, which I refer to as ACTL, and the Quest CCS project, which is operated by Shell Canada. These two large-scale projects are subject to mandatory knowledge disclosure laws in the province. Uh, and they're required to disclose their on an annual basis their financial and operating data, as well as what their estimates for cost are, and they release these comprehensive annual reports. So what we decided to do was to dig into these reports and use those numbers as a proxy for the Pathways project's costs. The thinking and rationale behind that is they're located in the same province. They're exposed to similar macroeconomic variables, similar labor markets, similar energy markets, financing costs. And so we chose to adopt the costs that have been disclosed because these are actual costs for projects that are currently operating, as well as estimates from proponents who have built and operate CCS plants today in the province of Alberta, and use that to provide insight into what sort of cost pathways will be expected to incur if this project goes ahead. Um, Now, the Alberta Carbon Trunk Line in its financial disclosure lists its average cost of net CO2 captured at $106 per ton. And while the Quest project lists its average cost as 165 or well, approximately $166 per net ton of CO2 captured. However, we believe these are significant understatements of the true cost of capture and to operate these CCS facilities. And the true costs we believe are materially higher than have been disclosed. And I'll go into why as I go deeper into the findings of my research. Next slide, please. So we'll go into the findings. I've spent many time digging into the annual reports, studying the provincial carbon markets that these carbon credits are going to trade under. And we looked at CCS facilities across multiple jurisdictions. IEEFA has spent many years looking at CCS plants across the globe. And a lot of our research papers are on the website. A lot of our findings from previous research into plants in different jurisdictions are available on our website. And next slide, please. The first trend that I have observed is there's a significant cost escalation at the CCS plants that are currently operating in Alberta. At the Quest facility, operating costs have pretty much doubled over the last couple of years, from about $34.70 per ton of net CO2 captured to about $75 in 2022. There was some improvement last year, but on average, they're pretty much doubled their costs, and annual growth rate of about 8% per annum in operating costs. Next slide, please. This trend is the same trend was observed with ACTL's numbers. Um, ACTL has seen its cost go up from $30 per net ton of CO2 in 2020, when the first year of full operation, to about $65 2022. That's an annual growth rate of about 13% per annum. These increases are per net ton of CO2. So there's no associated increase in capture rates. Essentially, they're not capturing more CO2. That would explain the rise in these costs. And if you're not capturing more CO2, they're also not generating more revenue. These increases are essentially due largely to energy cost inflation, as well as materials and labor. These increases exceed the rate of inflation in the broader economy, because there has been some inflation in the last couple of years. But these rates that we're seeing in these plants that are actual costs are far exceed what the rates of inflation are in the broader economy. So essentially, this is the first red flag. Next slide, please. Another observation that I made is the levelized cost, the average cost that were disclosed by both proponents of the CCS plants that are currently operating. There are a lot of assumptions that are made coming up with that average estimate. There's assumption on the life of the facility, 25 years. The assumptions of general inflation rate in the economy, the cost escalation rate, which is essentially the cost growth rate each year over the 25 years, and their estimates of the mass of CO2 that's expected to be captured and avoided, which is essentially the net CO2. And the first thing, another thing that I observed is that those estimates that were provided um, are based on an assumption that costs are going to grow at 1% per year over 25 years on average. Well, the first couple of years, we're already seeing 8% and 13% growth rate. So that tells me, unless there is some magical sort of efficiency increases from now until the next decade or so, if costs continue to rise even half of what we're seeing right now, you're going to see per ton costs are going to be significantly higher than the levelized estimates that were disclosed earlier. So that's part of what informs my conclusion that the current estimates are largely understated, and in reality, these are way more expensive to operate and construct than have been projected, and we're seeing data evidence of that. Next slide, please. Another phenomenon we observed was CCS facilities in Alberta, as well as across the globe, are struggling to capture the projected amount of CO2 on a long term, on an annual basis. And their on average cost estimates, the Quest facility projects that they will be able to capture 0.9 million tons of CO2 per annum over the next 25 years. And the Alberta Carbon Trunk Line, 1.48 million tons over the next 25 years. As we can see, they are barely able to meet up with those projections for multiple reasons. But this phenomenon is not only isolated, or is not only being observed in Alberta, these current plants. So next slide, please. We see something similar to that happening in another CCS plant in Canada. That's the Boundary Dam in Saskatchewan, which one of my older colleagues has done a lot more research on. And we see that the target of 1 million tons of CO2 captured on an annual basis, there seems to be an underperformance of that target, and the plant is struggling to meet that. Next slide, please. And across board, across multiple jurisdictions, multiple applications, the industry has a benchmark of 95% of CO2 emitted being able to be captured, and how this is an efficient technology. But we see that these are the hypothetical, theoretic goals that are not being met across board. I think this is an indictment, but this is what the data says. And next slide. This actually came out after I released the report from the Equinor Sleipner CCS plant in Norway. And essentially, we see that the capture rates have fallen off totally in recent years. This plant is not performing as expected. For a variety of reasons. I guess each plant might have their own particular technical challenges, but the data we're seeing shows that this is across board. Next slide, please. Now, the reason why operating on the performance of failure to capture CO2 to projected levels also has a financial dimension to it. I say operating risk is financial risk. If a project is unable to capture enough CO2 as projected, and then such a project will be unable to generate sufficient carbon credits. And when your carbon credits that you generate are reduced, essentially that is a direct effect on project revenues. And some costs are fixed, regardless of whether you have zero production or you're able to capture 1 million tons. And those costs still need to be covered over the course of operation. So capture underperformance has a financial dimension to it and leads to reduced revenues. Another way to think about it is the equation for the levelized cost, or how that figure, that average cost is derived, is an estimate is made of the total lifetime cost expenditure on the plant, and that's divided by the total lifetime or average annual mass of CO2 that should be captured each year. You divide those two and you get that metric of average cost per ton over the life of the facility. Well, if you have a reduction in the denominator, which is the amount of CO2 that's being captured, and you have some fixed elements in the numerator that remain stagnant, well, what that means is that your average cost per ton increases. So when you have capture underperformance and you're unable to capture sufficient CO2 for whatever reason, your average cost per ton goes up and your revenue reduces. And we're seeing this across board, multiple CCS projects. Next slide, please. For the Pathways project, there are even additional risks that the project would have to face. For one, this plant or this project has 13 separate carbon capture facilities. Now, the reason why we're seeing underperformance in multiple projects is technical issues, maintenance shutdowns. You could have pipeline leakages. You could have a shutdown in production. The Sleipner issue in Norway, I understand that that field isn't producing as much gas, I believe, that it should. And if you're not producing gas, then you don't have CO2 being emitted, and then you're not able to capture any CO2. That affects the capture rates of the facility. Any sort of disruptions, labor strikes, or any subsurface abnormalities that are discovered in the central location, essentially a lot could go wrong. And with the Pathways project, you're having 13 separate capture sites. Any negative event that happens in these sites or the 400, anywhere along that 400-kilometer trunk line, you're going to have reductions in your carbon capture, the mass of CO2 being captured, and you're going to have financial consequences. In addition, no commercial scale gas-fired facility has captured CO2 under normal operating conditions, which is what Pathways is projecting to do. And capturing CO2 from gas-fired facilities is expected to be even more energy intensive and more expensive than the current CCS projects that are in Alberta. So these are also additional risks that this project face. Next slide, please. Another observation was that the levelized cost of CCS seemed to exclude certain non-operating costs that are critical to the operation of a CCS plant. If there's any sort of borrowing, there will be interest costs that would have to be incurred. But when I look at the classification of costs that are factored into the levelized estimates that are being produced by the CCS plants, and I was unable to see any provision for financing costs or insurance. In the case of the Pathways, you have a project with a very large footprint and across multiple communities. That leaves room for things that could go wrong. And in Canada, the regulators are very strict about liability with leakages and pipelines, and they want to see money being put up. So it's a fair assumption that that project would have to put up material insurance premiums to cover, and in case anything goes wrong. That is an additional cost that I'm not seeing being factored into estimates, as well as depreciation, taxes. These are hard to quantify, but nonetheless would increase the true cost of operation for this facility. Next slide, please. So that was what we found out in terms of risks on the cost side of things. Delving into the revenue side, next slide, please. Um, unlike the 45Q subsidy in the States, the CCS plants in Alberta don't have a fixed value for each ton of CO2 captured. You generate a credit, but that credit has to be monetized in the provincial carbon market. And that market is subject to supply and demand, as well as the structure of enabling legislation that created that market. And these have some implications for the revenue of these projects going forward. A little bit of background in Alberta, the carbon credit market is referred to as is backed by the TIER regulation. TIER is a technology innovation and emission reduction law, and I'm just going to summarize it. Essentially, it applies to facilities that have over 100,000 tons of CO2 equivalent emissions per annum. And these facilities are giving a benchmark, an emissions benchmark. If you're able to underperform that benchmark as an incentive to do so, you are able to generate credits. So in this chart on the right, facility B is able to underperform the benchmark that has been assigned and you generate credits. On the other hand, facility C emissions have gone above the benchmark that's been provided. And in that case, that facility has a compliance obligation. And that compliance obligation is what essentially forms the demand for carbon credits in the market. So if you have a compliance obligation, you have to purchase some of the carbon credits from facilities like facility B, who are more efficient or supposedly can install things like CCS that reduce the emissions. And when you purchase those credits, you're able to comply with the law and provide revenue for facilities and B. So that market is structured as an incentive for emitters to be more efficient and install emission reduction technologies such as CCS. Um, However, facility C has an alternative to achieve compliance obligation based on the law. You can either purchase carbon credits or you can make a payment into the tier fund. Payment into the tier fund is aligns with the federal carbon schedule. For each ton of CO2 that is subject to your compliance obligation, you can make a payment into the tier fund, and the carbon schedule is currently about $65 a ton and is supposed to top out at 170 a ton. Now, there's no provision to increase the price of the carbon schedule, either for inflation or for any other consideration as at today. The legislation says 170 a ton is tops. So in a scenario whereby carbon credits happen to be in tight supply in the market and they're trading for $200 per ton, facility C doesn't have to purchase a credit to achieve the compliance. They would simply go to the tier fund and make a payment at a max amount of $170 per ton. Well, that tells me that if these carbon credits trade over 170 a ton, there's going to be limited demand. So that price for the carbon schedule is essentially a ceiling. I don't anticipate, in my opinion, the carbon credit price is going materially above $170. In my opinion, that is a ceiling because if they go above that price, there's no incentive for other facilities to purchase credits. They could just make a payment into the tier fund and achieve the compliance obligations for less. So I don't see the incentive why they would want to pay more. So that my conclusion by looking at that is that there's a price ceiling of $170 per ton for each carbon credit and each ton of CO2 that's captured and sequestered. Second slide, next slide, please. While there is an effective ceiling, there is, however, no floor on what these carbon credits can trade for. The provincial and federal governments are promoting carbon capture plants in the province. They've signed sequestration agreements and projected about 50 million tons of CO2 to be captured in the next couple of years, I think before 2030. And if these plants get built, we're going to see an influx of credits being generated and being issued and being traded in the provincial carbon markets. These markets, the price is subject to supply and demand. If we have the same or similar level of demand and you have this huge influx, the prices of these carbon credits are going to drop, and that's going to negatively impact revenues that projects like Pathways and other CCS projects can generate to cover their costs. So there's a risk of oversupply looming, and that risk is widely telegraphed by market participants and industry as well. And that seems to be there seems to be a appreciation of that risk going forward. The government has tried to make some modifications, make more facilities be subject to compliance obligations and tighten the benchmark that may increase demand. But I don't believe that these will be enough to overshadow the huge influx of credits that could be coming into the market. So that's a real risk for projects going forward. Next slide, please. And then lastly, we have the political carbon price uncertainty, which is the enabling legislation for the carbon values being the carbon tax. That's delving into politics, but does that legislation hold? If there's a new administration, does that get scrapped? Does that get remodeled? And if it does, is there an incentive for other facilities to purchase credits? Is there a compliance obligation, or is it more of a voluntary compliance? Well, any changes that change the structure of the carbon market and doesn't require companies to pay that tax, that compliance obligation will reduce demand for carbon credits. That has financial implications for a project like the Pathways that's expecting to raise revenue through sales of these. Next slide, please. Um, so after looking at all of these risks in entirety and looking at the business model, it is my opinion that the CCS business model is flawed fundamentally. You have, as at today, based on the regulations and the realities, is that you have a scenario whereby costs are rising, which is illustrated with the dotted line, but your revenue is capped. So as time goes by, you're going to have a compression of margins, and at some point, losses are just going to keep widening as long as your costs go up. And that's not a viable or sustainable business model at all. You have elevated costs, technical challenges that are widespread, non-operating costs that are material, and revenue stagnation and even uncertainty. So when I look at all of those in entirety, that informs my conclusion that this is not a viable business model, and this project is unlikely to be viable independently if it goes ahead to be constructed. Um, the only way that a project that's facing these economics could get built is through subsidies, external subsidies. Now, the subsidies could come from the private sector or the public sector, private sector being the parent companies, or from the government. And next slide. That conclusion, when I looked at the numbers, and it became clear to me that this is not a secret. The industry is well aware of this, and the government probably is as well, because the two commercial scale CCS plants in Alberta today are able to exist courtesy of extensive government subsidies. Um, we have estimates of 50 to 85% of construction and operating costs being subsidized by the government for the Alberta Carbon Trunk Line, as well as the Quest facility. The Quest facility, as many of you may be aware, also was a beneficiary of a deal that gave 2 carbon credits for each ton of CO2 captured. that only that facility is going to enjoy so far, essentially doubling their revenue per ton of CO2 for the earlier years of that project. And those sort of unusual subsidies and financial support are the only way these CCS plants are likely to come into fruition. So the question now is, should the government be the one who steps in to subsidize these projects, or should the private sector be the one? In our position, the government needs to be careful not to over subsidize private sector projects. And our position at IEEFA is that CCS projects don't work as a technology. CCS has severe technical challenges. It doesn't have a good track record, and it's not a viable tool as a climate solution. In the past, CCS was used mainly to stimulate oil production, and that is what has been used for many years in the industry for. But being introduced as a climate solution has not been proven to be a long-term viable plan. And it's also very expensive. And in some cases, a lot of money has been spent. And when we realize that it doesn't work and they shut down and that money gets lost. Another area of concern is that an unprofitable CCS project is going to struggle to deliver benefits to the host communities and stakeholders because it can barely cover their costs. So what can they even do for the communities that they're hosted in? That could also be a challenge for them. And even if these CCS plants are able to get it right and capture the CO2 as they intend to, and able to leverage generous government subsidies, long term, I don't believe, or we don't believe that this is going to help Canada achieve the climate goals. Because, for example, the Pathways CCS plant is focused on capturing CO2 at site. But if we have an increase in production and more CO2 gets combusted, and there are also scope 3 emissions that would be released into the atmosphere when that additional production is used in the economy and combusted across the economy in such a scenario, on a net basis, countrywide emissions might actually increase even when you have a successful plant that's capturing CO2 at site. So the CCS facilities could help to reduce tier 1 and tier 2 emissions, scope 1 and scope 2 emissions, but scope 3 emissions could also go up even higher from increased production. So net, how is that achieving the country's climate goals? So we don't believe that this is a good, provides good bang for buck for the government purse, so to speak. And we feel it's a risky endeavor that should be approached cautiously. And yeah, that's it for me for today. I guess we'll delve into Q&A now.
Yeah, great. Thank you so much, Mark, for your presentation. I can go back to any of the slides if people have questions about them. We already have some questions in the chat, so I'll go through them in the order they came in. But if you have other questions, please submit them through the Q&A section. And if we run out of time, Mark's email is here. You can feel free to follow up with us after the webinar, and Mark would be happy to dive into anything we don't get to. So our first question, Mark, is from Eric Hansen. Eric asks, since I would assume both provincial and federal funding will be involved in such a project, shouldn't the cost be available for the public to access? I'm not sure if you know that one, but go ahead.
Yeah, no, those are my thoughts essentially. This is essentially a project that's requesting for taxpayer funds on a large scale. If you're talking about $16.5 billion budget, and we're looking at half or even maybe 80% of that being covered by taxpayers, then at the very least there should be transparency, and we can know what these costs are, what the breakdown is. There definitely needs to be more transparency so that the public can be aware. So I'm definitely in alignment with Eric on that. That's our position as well.
Thank you, Mark. Next question is from Case Bacon. Thank you for the analysis. Is there any sensitivity analysis conducted on this assessment?
Well, I did do something, but in the report, it's included in the report. I tried to model what the difference in the average cost would be based on varying levels of capture performance. It's not a perfect sensitivity analysis because there isn't a lot of data from pathways on it. So there was a lot of there was a gray area, a lot of estimation and guesstimation. Um, there's also there's also there's also there can also be some more analysis done on the long-term um cost escalation rates. What we've seen have been high rates in the last couple of years, but if we do that across 25 years, or if we moderate that, what would be the average cost? I did try to project 13% cost increases over 25 years, and the average costs were it was ridiculous. Like it's not even out of this world. So there has been some sensitivity analysis, but there is room for more of that to be done. But without a lot of concrete details from the project proponents, that sort of analysis is would be based on imperfect data and a lot of guesstimation. But there is some of that in the report. Yeah.
Great, thank you, Mark. And I did put the link to the full report in the chat so you can see the full report and some of our other work on CCS that Mark mentioned on our website. Next question is from Bianca Bhattacharya. Have you looked into whether the carbon price in any way affects capture rates?
Um, that's a good question. No, we haven't looked at that, but I don't see how um I don't see how there would be a relation between the prevailing carbon price and capture rates per se. The carbon price could give an incentive for these projects to be moved forward and to be built. But when they are built, I think capture rates are more are a function of technical and the technology being employed and what sort of process is being employed in the capture site. Those are the variables that affect what the rates of capture are, not necessarily what the carbon price is, what the prevailing carbon price will be. It's definitely something that would require some more thought and maybe some more digging, but yeah.
Great, and yeah, Bianca, if you'd like to discuss that more, please take a note of Mark's email address and we can follow up with you. Okay, next question from Eric Hansen. Has the CCS technology been improving over time?
The industry says that it has been, but I haven't come across data to support that yet. So, yeah.
Great, that was a quick one. Next question is from Matt Dreiss. I'm not sure that we have this, but do you have a slide comparing capture rates to capture efficiencies? So capture rates would be subject to externalities like production rates, as you mentioned. Capture efficiency might be more indicative of the costs.
Um, that's a good question as well. No, I don't have that chart. That would be something that I would have to dig deeper into and explore further. But I did make a note of that.
Okay. Next question from Eric Mellis, and it's a little long, so I can repeat it if we need to. So Eric asks if that EPC price is not around, let's say, US dollar 150 per ton CO2 or above RE or green processes will never become viable. So what is your opinion? Actually having an escape route funding the tier program that will always be the preference. In other words, emitting CO2 will be economically more beneficial as opposed to capturing for many emitters. So if you have any thoughts on that, and if you want me to repeat it.
Um, yeah, I think that there is a carbon price that would make this viable. But who pays that price is the question. In the US, the 45Q, um, as it was passed, there's a fixed price for each ton of CO2 that's captured and sequestered. The US government pays that amount, but if it's subject to a market like we have in Alberta, then it's going to be subject to supply and demand, and that value is going to change. So they might they might introduce some measures that try to provide support for the market price, maybe increase demand, which we've seen them do. But um, yeah, it would still be variable, and at some point, it definitely would be, especially from a purely financial perspective as shareholders, it may be more beneficial to not proceed with these plans than it is to if the cost of capture and running the plants exceed that, and there is a point where it might be more efficient not to proceed with these. Yeah, I think so. Yeah, I'm not sure if I got that question right, but that's my. We can also chat later as well.
Yeah, I encourage everyone to follow up with Mark via email, and I can help facilitate that. Okay, the next question is from Taylor Noakes. Taylor's question is, how sure are you about the Pathways project not being primarily an EOR effort?
Okay, so like I said, it's not clear. I didn't see anything explicitly stating that they are going to rely on EOR as a revenue source or as part of the design. But the reason why I didn't see anything is because there isn't a lot of information about this project that's publicly available. We have reached out to them, but even when they had the issue recently when they took down some of that data from the website, when there was a issue with the Competition Act and the new law being passed, they took down even more information. So the transparency is even less now. So it's not clear. It's not clear. It's something that we'll find out eventually. Being that the proponents are in the oil industry, the oil sands majors, it seems like this would be the sort of project where EOR would be included in it. Uh, but it should also be stated that in having EOR components would reduce the subsidies that the government will provide to the project. In the US, CO2 that's captured but used for EOR generates a reduced amount of the tax credit. And with the ITC subsidy, the investment tax credit in Canada, there's a reduced financial coverage if elements of the project are used for EOR. So there's also a cost involved with that, but it's not clear. And I'm not sure if it will be used for that or not. I guess we'll find out as more details come out.
Great, thank you, Mark. Next question um, is from Matt Hulse. If the carbon tax is scrapped, are there other incentives on Pathways to continue with the project? For example, do US oil refineries, other downstream customers care that bitumen has lower emissions intensity?
Yeah, well, I think in that case there would be incentives, but I think that because from my understanding, the tier carbon market in Alberta has existed for a long time, even before the Greenhouse Gas Pollution Pricing Act was passed on the federal level. So there might be voluntary participants in the market. There might be corporations that decide to still purchase carbon credits out of their own personal philosophy and out of their own corporate ideologies and their missions. So there will still be demand, even if it isn't mandated by the law or if it isn't tied into. But I think that having that law repealed will take out a lot of the substance and a lot of the demand for these credits in the market. So I think it would have a negative material effect on carbon credits sales, pricing, demand. It might not totally eradicate it, but I don't see how that could be a positive thing at all.
Great, thank you, Mark. Hard for me to find the mute unmute button sometimes. Okay, next question is from Paul Weidman. I'm not sure if you're familiar with this project, but we'll throw it at you. Paul asks, ADM experienced well issues at its Illinois capture site. Is viability of CCS challenged by these types of well failures?
Yes, we're just discussing the ADM issue when we're looking at the um Sleipner case. And according to my research, anything that affects the capture rates of CO2 is a serious challenge. So with the Sleipner, from my understanding, is that the reason why production capture rates are falling off significantly is because that particular field isn't producing any gas anymore. I think it's been producing for many years. It's been depleted. But regardless of what the case may be, if production is interrupted and then there's no CO2 being emitted and capture rates fall, that's definitely a negative for viability because that reduces revenues that you can monetize from your credits. And that also increase costs because there are some fixed costs that you would incur keeping that CCS facility on stream. So any sort of accidents or shut-ins that happen either ADM or any of the 13 pathways facilities is definitely negative for viability. That's what the data I'm seeing says.
Great, thank you, Mark. Next is Jessica Kelly. Jessica asks, what are the implications of lowering or leveling the cost of CO2 ceiling, so down from $170, on the feasibility of these projects?
Yeah, that would be negative. Because if you lower that, then the compliance obligation from emitters, the alternative they have is either you purchase a credit or you pay into the tier fund. So if you don't have to pay, if you pay into the tier fund at a lesser rate than 170, that's even it just reduces the ceiling, the effective ceiling on carbon prices, and that just reduces how much you can, as a CCS facility proponent, how much you can expect to generate for each ton that you capture. And while your revenues or your carbon price ceiling is reducing, your costs are still going to be stagnant or going up. So it definitely would have an immense negative effect on the financial viability of these projects, in my opinion. Yeah.
Great, thanks, Mark. So we have just a few more minutes left and only a couple more questions. So I think we should be able to get to the ones currently in there, and then we will call it a day. So I have a follow-up question from Taylor from his EOR question. He just wants to clarify, did you say that Pathways has not provided or they do not have data or information on the financing, insurance, depreciation, or tax costs?
They definitely have that data. These are one of the largest oil sands companies in the country. Their staff are very smart and resourceful people, and they have that data, but it has not been released. To the best of my knowledge, it's not available in the public realm, and we did reach out to them for data, and we were not able to get anything.
Thank you, Mark. Okay. Next question is from Ahmed Youssef. Is there potential for the development of capture technologies, such as improvements in solvents, to reduce operational costs and enhance carbon capture and enhance capture efficiency in carbon capture and storage in recent years?
Yeah, he said, what's the question? Is there a possibility? Is that what the
Is
question
there
is?
potential for the development of these technologies to improve their, efficiency and operational costs?
Okay. Yeah, I'm a finance guy.
Mm.
Mostly deal with the numbers. Not necessarily very knowledgeable about the technical aspects, but I think that if we're being realistic, we can't discount that scenario. Anything can happen. Um, it is possible. There could be some innovation, but nonetheless, CCS technologies have been used for many years, decades in the industry. And as at today, there's no data to support that there is any sort of radical increase in efficiency or radical new technology that's reducing the cost of this process, of this technology, of this concept. We see costs still continue to rise across board and a lot of technical challenges. So is it possible? Well, anything's possible. We can't discount it, but have we seen any data to support that being deployed as at today? No.
Great, thank you, Mark. And we will close it out with one last question from Bianca, and then we will wrap up. Bianca asks, since you mentioned Scope 3 emissions, are there any programs that specifically support CCS with gas-fired power plants? And does the IRA have anything, or is it also mainly upstream production subsector protection, production subsector? You might not know about the IRA since that's in the US, but
Sorry, can you repeat that?
yeah, no problem. So Bianca asked, since you mentioned Scope 3 emissions, are there any programs that specifically support CCS with gas-fired power plants? I'll start with that one, and then if we have time, we can address the second half.
Yes, I'm not aware. I'm not aware of any program that exists specifically for gas-fired applications for CCS. There might be, but I'm not aware.
Okay, great. And then the second question, I believe is referencing the Inflation Reduction Act, but that's a US bill. I don't know if you have any insight into that one.
What did she ask about the IRA? I have general.
Does anything in the IRA support the CCS with gas-fired power plants, to your knowledge?
Yeah, no, to my knowledge, the IRA is CCS. There's a provision for CCS monetization, and I think direct air capture has a higher revenue for each ton that is each ton of CO2 that's removed from the atmosphere through DAC. I didn't see anything specifically for gas fired, but yeah, like you said, I might not be the best source for that.
Great. Well, that is the last of our questions. We timed everything perfectly, and I have a couple other that we didn't get to that I'll follow up via email. But thank you so much, Mark, for your presentation. We will have the recording and the slides available shortly. And if you have any questions, you can reach out to me, Susan Torres, or you can reach out to Mark. Mark's email is right here. And we really appreciate you all taking the time out of your day to learn more about this project.
Thank you.
Thank you.